Alright, so our lecture 11 talks about dividend policy. So in this chapter, we will talk a little more about dividend um, relating to Miller and Modigliani's, these two persons' theory on dividend irrelevancy hypothesis and the concept of dividend as a residual. Right? You may not understand this at first, but later on, you will be more familiar with what all this means. And then we will also learn to describe the influence of dividend policies in attracting all sorts of different clients and shareholders, and how taxation and dividends are linked together, and how dividends can be a signaling device. So next, we will also learn about how dividends that are received now or in the future have different values. All right, and we'll talk also about agency theory, impact on dividend, and we want to talk about not just cash but script dividend, and this new thing called share repurchase. Later we'll see. So first, before I start, I have to make sure that you know what is a dividend. So you are all accounting students. You know how to do basic accounting. You know what is a balance sheet. You know what is a income statement and trial balance, and all those sort of things. So this will be related to the end of your income statement. So if you remember how to construct an income statement, how to do an income statement, it always starts with sales. Sales minus cost of goods sold. Then you get your gross income. And then gross income minus all other expenses, okay, like operating expense and all sort of things. Then you get operating income, right? And then operating income minus all other taxations, things like that, it will be income after tax and so on. And minus depreciation, it becomes earnings after interest and tax and depreciation. And all this at the end, it becomes your income, right? The company's income. And this company's income can be used for what? There are several purposes for this income. So company makes money. When they make money, what can they do with this money? This money can be reinvested into the company, just like expanding. Like if you own a restaurant, maybe to buy new tables, new chairs, or maybe do some upgrading and improve your lighting and things like that. So this money can be reinvested. Alternatively, if everything is new, this money can be given back to the owners of the company. So how can this money or these earnings be given back to the owners of the company? It can be given through what we call as dividends, dividend payment, especially cash dividend. So when the company makes a lot of money and it has nothing to do with the money should be given back to the owners in the form of dividend. So this is what dividend is. And every business that you go into, right? Like you have money and then you use your money for a business. What is your ultimate goal? Your ultimate goal is to get more money. Right? Why do you invest your money? Why do you start a business? To get more money. So this money is would be considered as the income or the dividends that you are about to get. So this is the main purpose of this chapter, to understand in detail more on what and how dividend goes about. Okay, so dividend is not just the money that you will receive. So as an accountant, as any stakeholder of the company, dividend is a very important thing. So what things can dividend affect? All right, so now we look at the problem. Can shareholders' wealth be enhanced by altering the pattern of dividend and not the size of dividend overall? Okay, what it means. Okay, so this company, let's say this company makes $1 million profit after tax, everything. So this $1 million is extra. So this $1 million can be reinvested in the company. But if the company do not need this money, so this money can be given back to the owner, the 1 million. But this 1 million can be entirely given, right? Or this money can be given in stages. That means every 3 months or every 4 months or every half a year is given back. Let's say you give two times a year. So this 1 million split into 500,000, 500,000. 500,000 after 6 months, you give to the shareholder, and another 500,000 in the next 6 months. So why do companies can do this? Why do companies do this sometimes? So the reason why is because this 1 million is an extra. So it can be kept in the company in case of any emergency. For example, last year the company is doing well, so they make a profit of $1 million. But coming into 2020, suddenly MCO lockdown due to COVID-19. So this company is operating as usual, but the sales is not as much. So they are making low sales, but the expenses remain. So company is probably making losses every month. They make loss, right? Because they need to pay rent, they need to pay salary, they need to pay all the fixed expenses, but they do not have sales. So they are making losses every month until CMCO, when the economy open up again and people can go about everywhere to buy things. So when company last year, when they make 1 million, if they give out all this 1 million, this year they will die. Why? Because they do not have money to sustain their losing operations. Okay, negative cash flow. So if they were to retain this $1 million in the company and they didn't give all out as dividend, so they still have this $1 million as a floating thing. So they can hang on to 1 million to survive for this 1 year until economy gets better next year. Then they start making money again. All right. So this is one reason why companies can choose not to give out all their dividends. All right. So do companies change, or do the wealth of the owner is owner of the company deeply affected by how companies choose to give out their dividends? So you have to know there is a separation system where company is company, owner is owner. They are separate things. So when the company make money, it doesn't mean that the owner makes money. No, it's separate, totally legal separate entity. Okay, it's two different things. Okay, so in order for owner to get money, they have to be paid the dividend. If there's no dividend, means the owner will not get money. All right. So we go back to this slide. The assumption that investment opportunity and returns on business investment are constant, and extra value may be created by changing capital structure is constant. All right. So let's go on. Dividend, some background. Dividend can be given as final dividend. That means one time, one shot, 1 year they give one time, right? Alternatively, it can be an interim dividend. Interim dividend means periodically. Every 3 months they give one time dividend. So if there is 1 million, they can split into 4 times. So 1 year, 4 times. So every 3 months they give this dividend. So let's say last year they make 1 million. So this year, this 1 million will be split into 4 times. So every 3 months, they will pay 250,000. Right? 4 years, 4 times lah in this 1 year. So 1 quarter, 250,000. It can be paid in an interim method, or alternatively, it can be paid in a final dividend method. Okay, and a dividend may only be paid out from accumulated profits. So if the company do not pay any dividend, although they make profit, they can keep that money. Okay, keep the money under what? Retained earnings. Retained earnings is accumulated profit. So they make money, but they don't want to give back. They keep it in the company in case of any emergency. So when you keep this and they continue to make profit every year, so this profit will grow, grow because you are, it's like eating and you are not letting out anything. So the company will be more and more rich, more and more money because these retained earnings are kept in the company, didn't pay out. Okay, so this Modigliani and Miller, this 2%, M&M in short, we call it. M&M has this theory where they said that dividend policy is irrelevant. So dividend policy means what? Dividend policy means the structure of how dividends will be paid. So dividend can be paid many ways, right? As I said, it can be paid in interim method or it can be paid as one shot final dividend. So it doesn't matter. M&M say it doesn't matter how dividend is paid, and it will not affect the value of the company. Okay, so they say, yeah, doesn't matter lah. How dividend is paid is not important because this 1 million, it belongs to the owner mah. So pay 3 months once or you pay 1 year once, it doesn't matter. Okay, but this is assuming that, okay, all these factors are listed on this page. Assuming that there are no taxes, there are no transaction costs, such as there are no brokerage costs and they can issue shares, no transactions. Okay, so no transaction costs. And assuming that all borrowers can, all investors can borrow and lend at the same interest rate, all investors have free access to information, and investors are indifferent between dividends and capital gains. Okay, these are all the assumptions, but it is a bit too early to understand what it all means. So now we will go into some examples to understand. All right, to understand even further. So what and how dividend policy can be irrelevant, means dividend policy is not important. All right, so now let's take a look at this example. A firm which has plenty of positive NPV project. Positive NPV project means the company is making a lot of money, but nevertheless paid all profit each year as dividend would not necessarily be restoring shareholders' wealth, because in ideal world, any money paid out could be replaced by having a new issue of shares. If a company choose not to pay dividend and shareholders require an income, and this could be achieved while leaving the firm's value intact, means homemade dividend. So let's take a look at an example at the bottom. So if we take a look here, P0. What is P0? P0 means the price of the company. P0 means the value of the company. Company value. So company value depends on what? Company value depends on what money, what earnings that they can make, what cash flow that they can make. So the formula is this. You see here. Okay, you see here, this is the formula. Okay, so there's additional information here. Belvoy PLC, here, this company, is an all-equity company, means they have no debt financing. So all the money belongs to the owner, means because they don't have borrowing, so they don't need to repay their debt. Okay, an all-equity company which has a policy of paying out all cash flow as dividend. The company is expected to generate net cash flow of 1 million, and the cost of equity is 12%. Right? So how do you value this company? So the value of this company is P0 equals to D0 plus D1 divided by KE. Okay, so what does this mean? This means that the value of the company is calculated by the dividends, 0 means dividend today, and D1, the dividend that you will get next year forever. This, we assume that this company will make $1 million profit this year and forever. All right, so how do you calculate the value? You take this formula, and the formula is 1 million plus 1 million divided by KE, which is 0.12, and you get the value of the company. All right, which is 9.333 million. So this is the value of the company. Okay, so now let's see further how management, if a management has identified a new investment policy, so what can they do? So if this will produce additional cash flow of 180,000 per year starting in 1 year, the company will be required to invest $1 million. Now, the NPV of the project will increase shareholders' value by what? So the NPV of this project is what? Let's say this year, this company make $1 million net profit. So this net profit, $1 million, can be given out as dividend, right? Instead of reinvesting. So now the alternative is to reinvest into another project. And this project, what's the benefit? This project will give you an extra 180,000 per year forever. So what is the NPV of this project? We take negative 1 million, which is the initial investment, plus 180,000 divided by 0.12. This is a perpetuity formula, right? That means this 180 will go on forever. All right, so the net present value from this project is 500,000. So now the question is this project acceptable? Should you take this project? So as long as your NPV is more than or equals to 0, you should take the project. You should take the project. All right, so is this more than 0? Yes. So you should take the project. But you take the project, that means what owners will see? Owners will see that, oh, you need $1 million this year to reinvest. That means this year I don't get dividend. Right? So does it affect the owner's wealth? Right? Actually, it doesn't. Why? You see, so let's say this year, because they decide to invest the 1 million, so let's say this one is cash flow to shareholder originally should be 1 million, right? But they choose to take up this project, right? So you don't take up this project. So you take this 1 million, invest into a new project so that you don't get this dividend. So you take this 1 million, reinvest in this project. However, from next year onwards, you will get 1.18 million. So instead of 1 million every year, right? Instead of 1 million every year, now you will get 1.18 million every year forever. So now what is the shareholders' wealth? Shareholders' wealth now, P0 equals to what? D0 plus D1 divided by KE, right? So now D0 no more. So P0 equals to D1 divided by KE. So it is equals to 9.833 million. Say, what is it compared to previously? Previously, if they never take up the project and they pay out the dividend 1 million every year, the value is 9.333. 9.3 lah. Compared to if they take up this project the wealth will be 9.8. So why? Because they take a positive NPV project. So this is a positive move. But what happened in the terms of dividend? So what happens is that D0 will be 0. That means shareholder will not get dividend this year, but they will get 1.18 million starting from next year and forever, equals to D1 to forever, infinity. All right, so is this a good thing? Yes, it is a good thing. So what it shows is that dividends is not really an important thing as long as the company is using the earnings to make even more wealth than what shareholders can do by themselves. Right? So this company, by taking up this project, is actually increasing the wealth of the shareholder. But shareholder or owner have to understand that if they do not get dividend this year, it is so that they have a better wealth in the future. Okay, this is the understanding that owners must have. All right, so this is how it can be. If the project is financed through right issue while leaving dividend pattern intact, the effect of shareholder is the same, an increase of 500,000. So if shareholders still want dividend, they can get this 1 million dividend, but the company, in order to take up this project, they need another source of financing. They need 1 million in order to start this project. So where can they get their 1 million? They can get it through the issue of rights. Okay, so this is another kind of financing instrument. So they still give dividend, but they have to sell rights in order to make up for that 1 million. Right? Although this is not a very ideal move, but this is to keep shareholders happy that, oh, they still get dividend, so they don't feel so sad and they don't take it in a negative way. Hey, why I don't get dividend this year? Right? So the best policy for a company to make the shareholders happy and to help the shareholders achieve goals is to keep in mind that dividend should be used as a residual. Right. So what is the meaning? So you look at this slide, it explains that if raising of external finance is impossibly expensive, dividend policy becomes an important determinant of shareholders' wealth. What it means is that, for example, if the economy is bad, right? So what happens when economy is bad? Economy is bad means everyone do not have money. So when they do not have money, they are very scared. So they will keep all their money. And even banks, right? They will keep their money safely because they are worried that people who borrow cannot pay back. So at bad times, right? Even companies, you say that, oh, there is a positive NPV project. Even companies find it very difficult to borrow. When companies cannot borrow, how can they take up the positive NPV project? Right, and this project is very good. It will increase shareholders' wealth, but it needs 1 million. How can they get the $1 million? Banks will not lend them. Even if they found out the bank is going to lend them 1 million, during bad economy, the bank will be so scared, they will charge a high interest rate. So that means borrowing from the bank during this time, it will be very expensive. And when you borrow expensively, it will actually destroy the shareholders' wealth. So this is not really good thing for a company. So the best way is to use earnings in order to reinvest. So therefore, dividend policy becomes an important determinant of shareholders' wealth. So let's say cash flow is retained and invested within the firm at less than KE. That means shareholders, if they have the money, they can earn 10% outside. Let's say KE is 10%. They can earn 10% outside. But this company keep these earnings. They do not give to the shareholder, but they reinvest it in a project. This project earn only 8%. So in this way, they are actually making the shareholder poorer. They are making them worse off. So they are practically destroying shareholders' wealth. So it is better to raise the dividend payout. If the return from this new project is lower than KE, then give up this project and give the shareholder the money. Don't keep it. All right. The next one is if retained earnings are insufficient to fund all positive NPV, shareholder is lost and it will be beneficial to lower the dividend. So if company decide to pay dividend, but at the same time, by paying dividend means they have no money to take up this positive NPV project. So this way, by not taking up the project and paying shareholders this dividend, you will make shareholder happy for now, but you are actually also destroying their wealth because you can actually take up this project and make them wealthier. All right, so these are the theories of dividends as a residual. All right, any questions so far? Any part that you feel that I talk too fast and you do not understand? Everyone okay?
That part.
Sorry?
Dividend as a residual part.
No, not so clear.
Yeah.
Okay. I will cover this one more time. Okay, so maybe you do not understand what is the meaning of dividend as residual. Okay, dividend as a residual. Dividend is the earning of the company, right? The balance after you minus every expenses and every tax, right? The final amount should be the dividend. All right, dividend. So this earnings is the extra for the company. So if the company got extra, it's good. But this extra money, right? It can be used for many things. It can be used to upgrade the company. It can be used to expand, to grow, to invest in new projects or new planning or new things. Alternatively, this money can also be given back to shareholder. All right. Okay. So let's say this company is a Ramly Burger store. You invest in a Ramly Burger store, so this burger store make a lot of money. So at the end of the year, you have two choices. One, to use the money to upgrade your store. Maybe upgrade your stall into a shop. Okay? But this one needs a lot of money. So you can use the dividend money. Alternatively, you said don't need to upgrade to the shop. So since it is already making so much money as a stall, I want back all this money. Shareholder want back all this money. So you have to consider what is the benefit of both. The benefit if you use this money to upgrade your stall into a shop, then in the future your earnings, your cash flow will be double. So in your future your earnings will be more and more. If you don't want to do that, this money can be given to the shareholder and forever you will be a stall. You will not be upgraded into a shop. All right. So which one is better? So you cannot just say, oh, of course this is better. No, you have to consider which one actually have the better benefit to shareholder. If this money used to upgrade into a shop, but even in the shop, right, your sales cannot increase, your cash flow cannot increase, then you are actually destroying the wealth. Alternatively, if this money is used to upgrade to a shop and the shop business is very good, then it will increase the wealth to the shareholder. All right. So if it cannot increase the wealth, the money is better be given to the shareholder. If it can increase the wealth, then it is better to reinvest and increase the business. Is it clearer now?
Okay, a bit clearer already.
Okay, I will continue this, but let's have a short break first. Is it okay?
Okay.
Okay, we have a 10 minutes break. Let you think about it. And I'll see you after 10 minutes. All right, see you. All right, welcome back. If you are back, just give me a raise of hand. Just raise your hand if you are back. How about others? If you are back, give me a raise of hand. Jingwen, Yun Xin. Okay. All right. So we were. I'll cover a little bit more, and probably will not finish by today lah, because a lot of quite. I'll try to make you understand about dividends before we go further. All right. So, going on to the next slide, about dividends. What about the world in which we live in? So, in the real world that we live in, there are some transaction costs involved when you issue dividends, and through obtaining investment by selling new shares. And dividend policy will be influenced by the residual approach. So, as what we understood previously, of course, when we want to give dividend, we don't just give based on profit. That means when company make profit, they make 1 million, then you give 1 million dividend. No, there are many things else to consider. When you make profit 1 million, should you give back to the owner or should you reinvest? That's one question. Should you give back or should you reinvest? All right. If you give back, why? If you reinvest, why? Which one will increase your shareholders' wealth in the long run? If you can reinvest and you can make a higher return, then of course you reinvest. If you reinvest and you make a lower return, then of course do not reinvest. You give back the money to the shareholder. All right. So all these have to be considered. So saying that is easy. However, in the real world, there are certain kind of psychology that you have to consider, such as the clientele effect. What is the clientele effect? It is actually a concept that shareholders are attracted to firms or to companies that follow a dividend policy that is consistent with their objective. And this policy will encourage stability in dividends. Why? For example, AirAsia is a big company, right? You can actually invest in the company. If you got money, you can own AirAsia. You can, right? So, but of course, the whole company is expensive lah. You can own a small percentage of AirAsia. So, what can you do is when you own the shares of AirAsia, what happened when AirAsia make profit? AirAsia will want to buy more aeroplanes, right? Because when they have more planes, then they can travel to more countries, to more location. This is AirAsia's goal. But as a goal of a shareholder, you buy shareholders stock, you buy AirAsia stock, you only want one thing, you only want profit. You don't care about how many planes AirAsia have. But AirAsia, of course, they want more planes. All right. So in deciding in that decision, right? Most shareholders, even yourself, if you invest in invest in AirAsia, you hope to get dividends, right? So, for example, you check that AirAsia always give dividend every year, and then when you buy you buy AirAsia stock, and then 1 year they never give dividend. So what do you feel? You feel cheated, right? You say, hey, what every year pay dividend, then now they never pay dividend. You feel cheated and you feel sad, and you then think that AirAsia is not a good company like last time. You will think that, oh, AirAsia is becoming worse and worse because last year they give dividend, this year they never give. So in order for AirAsia, the company, to make you happy, they are encouraged to take into consideration this clientele effect. Means they have to consider your feeling, right? So in that case, although AirAsia can use the profit to buy more planes, but they feel obligated. They feel bad if they buy planes and they use the profit to buy planes and you do not get any dividend. And you feel sad and you will sell the shares, and then many people will sell, and then the price, the value of the company will drop. Why? Because dividend is not paid. So therefore, due to clientele effect, the residual dividend policy may not be implemented. Means you still remember residual dividends? That means in order to increase the wealth, what is the right thing to do? They should not consider what the shareholders feeling. They should just go with what and how can they increase the shareholders' wealth. All right. Let's say, for example, when you are young, when you are small, your parents always ask you to eat vegetables, right? Ask you to eat veggie, eat vitamin, and eat your vegetable. But you, as a young kid, you don't care. You don't like veggie. You prefer sweet because sweet is nice, but veggie is not nice, so you don't want veggie. But do you know that your parents is thinking that, oh, veggie is good, so that you get all the vitamins in the veggie and you grow bigger and you grow healthier? That is what your parents think. But you are selfish. You think about yourself. You think veggie is not nice, so you don't want to eat veggie, right? That is when you are young. So when you are older, you become more knowledgeable. You understand, oh, veggie is actually good for my health. But still, veggie is not as sweet as the sweets, right, or sugar, right? So although you know that veggies are good, but you still have this feeling or this taste that, hey, veggie is not nice, right? So you will not like veggie, but you still need to eat them because they are good for health and everything else. So same as dividend. Dividends is actually not very good for shareholders. Why? Because instead of giving dividends, this money can be reinvested and make the company stronger and bigger. But you, as the shareholder, you don't care. You think that, hey, why? I want this money. That's the reason why I invest. So with that, the AirAsia or this company will be obligated. They feel bad if they don't give you. So they may decide to give you a dividend. And not only that, they will have to structure a stable and consistent dividend in order for you to get a proper dividend every year. All right, which may not be good for the company. All right, so in the next slide, we learned that tax can actually influence investors' preference for high dividends or capital gains from the share. Okay. Another thing about dividend is when company give you dividend, it is actually an income for you. Right? You are the owner, you are the shareholder. When you get dividend, this dividend is an income. It's just like you working. Or when you buy McDonald's, when you buy McDonald's, the price they advertise is nine $9, $9.20, 9 ringgit 20 cent. Right? When you pay, it's 10 ringgit. Why? This 80 cent is tax. Right? This 80 cent is tax. So same as dividend. This dividend may be 1 million, but when it reach to you, the dividend may only be 800,000. Why? Because 200,000 is paid for tax. Why? Because this is your income. My income will have to be taxed. So when there is high dividend, you will also have to pay high tax. So this will also affect the preference of shareholder. Why shareholders will not be happy if the dividend is too high, right? Because it will also destroy the wealth in terms of from the tax perspective. Okay, so dividend can actually act as a conveyor of information, such as every year this company or AirAsia pay dividend. Then 1 year they never pay. What does it mean? So it actually conveys an information. How come every year they pay but this year don't pay? Sure, there is a reason for it, right? So this is a conveyor of information. It provides an information to what is happening to the company. Is it in trouble? Maybe, right? Because maybe last year, AirAsia making a lot of profit because they can fly. But this year, AirAsia cannot fly, right? Because of lockdown everywhere in the country. So AirAsia cannot fly and they cannot pay dividend. So when company don't pay dividend, you will feel that something is wrong. So it is a dividend can also be an information tool. It is like a newspaper. They tell you something is going on about the company. All right. So take a look at this example. Take a look at this example. You take a look and see what happened. You see, in year 1997 to year 2011, so almost 13 years, 12, 13 years, right? So every year the company make profit, make earnings, right? 31.2 million, 37.5 million, 43 million. So these are increasing, right? Then here, 31, 30, 22, this is dropping, right? And then now they increase again. And then they drop again. So the earnings up and down, up and down. But if you look at their dividends of this company, what is happening? 17, 18, 20, 21, 22, 23. So it is always going up. So what is dividends and what is earnings? Earnings is what the company is making in terms of profit. Okay, what the company make profit. The profit of the company go up and down. You see? But the dividends of the company always going up. So no matter how much the company earn, the company make sure that they always increase their shareholders' earnings. They don't care what they earn, but as long as they make money, they make sure that from every year that the owner or the shareholder of the company have higher income every year. So this kind of company actually makes owner feel very confident, very comfortable with the company. You see, this company, although every year they make different earnings, but they are so confident, they are so stable that they can increase my dividend every year. Right? So this is a good and positive sign of a strong company. Right? Compared to, let's say the company gives 17 dividend. Let's say the company gives 17, then 16, then 15, then 14, then 20. Right? It's going down and then it goes up again. So what kind of dividend this is? This is an unstable dividend. It is not growing. It is more like fluctuating. Fluctuating means going up and down. So if this is going up and down, it is actually a very unsettling. This is very uncomfortable for owners. So owners will prefer and they will choose a company that is more stable. All right. So I think I'll cover this as the last slide because because quite a lot for you to digest. So the next thing to take into consideration is about the distant dividend. So dividends can be immediate or can be promised in the future. For example, Facebook, when they just started, right? When they started with Facebook, Facebook is not earning any profit. They are just building the company, building the website so that they have more and more function, right? Facebook, a lot of function now, right? But in the beginning, right, they are not making any profit. But now, Facebook is making profit. And how Facebook make profit? If you scroll on Facebook, scroll up and down, you after every few posts, you will see an advertisement, right? So this advertisement is based on the services that Facebook provide to their customers. Customer pay Facebook, and Facebook will use the data that they have in order to show you this advertisement. Let's say you are interested in 11/11 双十一 11/11 sale, 12/12 sale 双十二 双十一. So during this sale, right, you will see Facebook a lot of advertisements. Why? Because the customer pay them in order to, and all these advertisement that Facebook show, actually they earn profit from it. Why? Because customer pay them for them to show. Right? So Facebook make profit. But imagine before this, Facebook is just very, very few user and people don't trust them. So it's very hard for them to earn revenue, earn profit and earn income. So in the past, their dividend is almost zero. But they also promise a very high dividend in the future. So if we look at this statement here, according to Gordon, investors receive investors will look at further dividend to have more risk. So when you originally in the start, when Facebook just become popular, very few people will invest or will trust Facebook. Why? Because they do not have dividend, but they promise a dividend in the future. Right. So many investors will prefer a more stable company which already giving dividend or already giving a very stable dividend. So company that are already giving a stable dividend will be highly valued compared to Facebook. But now Facebook is more stable, so people value Facebook more. Right. So this is what people look at dividends. People prefer current dividend rather than future. All right. So this resolution of uncertainty, when dividend is in the future, there is an uncertainty, and it is an argument that has been attacked to the ground that it implies higher risk on the rate used to discount cash flow. Right. So if dividend is further in the future, it has more uncertainty. So more uncertainty will require a higher return. So in order for investors like you and me or owners, for you to invest in Facebook last time, you will be taking a higher risk because you do not expect dividend for maybe 5 years to 10 years. But once the dividend come from 10 year onwards, it will be very rewarding. It will be very high. So when you want to invest in Facebook at the beginning, you will require a higher return. Higher return means cheaper. Means Facebook used to be very cheap. So if you buy Facebook when they are very cheap, now you start to get dividend, and then now people will value the company more, and you can sell it for a higher price. So it's all is about perception. Okay, just like okay, baby chicken, right? When the chicken is small, right, it is a chick, right? 小鸡 lah. When it is a chick, all the chicken look the same, right? All yellow color. So how do you know which chicken will produce egg, which one no egg? You don't know, right? Why? Because when it's small, you don't know which is the male, which is female. So when you buy a chicken that is small, it's very cheap. Because what if you buy 2 chicken, both also male, so you got no egg, right? But when the chicken grow bigger, it is very obvious. You can see, oh, this is a female chicken, this is a male chicken. All right. So the female one, you will be willing to pay more. Why? Because female one will give you egg. So egg is like dividends lah, right? So when the chicken is already producing egg, then you know, oh, this chicken is stable. This chicken is female and already stable. They will produce egg. So I am willing to pay more for this adult chicken. But when the chicken is small, you don't know whether it's female or male, you will not pay so much because you are uncertain about the dividend. Whether this chicken will give you dividend or not. Okay, dividend is egg lah. So you don't know whether they will give you dividend or not. So you are more unwilling. You are less likely to buy a small chicken. But if you were to buy a small chicken, you will have to take into consideration the risk. What risk? Risk that this chicken will not give you egg. Why? Because it may be a male chicken. Right? So if you buy a small chicken, it will be cheap because there is risk. Right? But if this small chicken become a female chicken, then your risk paid off. That means, hey, I buy it cheap, but now they are giving me dividend every day. Right? And if the chicken one day stop giving egg, you buy that time, you know that every day this chicken give egg. But one day when you buy, one day they stop giving egg. So it is like a company stop giving you dividend. Is it an information? So what do you feel when the chicken stop giving you egg? You panic, right? You say, oh, I pay so much for this chicken, suddenly not giving me egg. So how? So it is like an information. Maybe this chicken is sick. So you will bring it to the doctor and everything. So just like company, when companies stop paying dividend, you will feel that, oh, something is wrong with the company. All right, so dividend is like that. I want you to imagine. All right, so basically, I just want to cover on this, on your understanding about what dividend is and what kind of information it can give to you. Okay, and I want you to think from the investor point of view and rather than an accountant. I know you are studying accounting, but you have to also know that all these numbers that you provide, what kind of information that owners want to see and how can they be affected. So you are an accounting, you do accounts, and then at the end it comes to dividend, and then you say, oh, dividend or payout. No, it's not as simple as that. You have to take into consideration many things, such as the return, the risk, and also clientele effect. All right, everything okay so far? Any questions?